Hello everyone, welcome to today's session. So today we are going to continue our discussion on chapter number 13. Before I proceed and I start the discussion, again, you guys can log in to the BOS portal with your IDs. Okay. After login, you can go to the join LVC Zoom live classes May 2027. And from there, you can join Zoom and attend this particular session. Okay, so you can go to the BOS portal, log in, join Zoom, LVC live classes, and then from here you can attend this session. Okay, now in last session we discussed about the group audits. We discussed about a lot of things with respect to the group audit, like what are the group audits, what is the responsibility of the principal auditor. We discussed about the SA 600 portions. We discussed about why it is necessary to understand what happens in the audit of consolidated financial statement. What are the issues, challenges that the auditor may face? A lot of things we discussed in the previous session. I hope you guys have read that. Before I start and deep dive, any doubts from the previous session? Any doubts? No? Okay. If no doubts, let me proceed ahead then. So what we are going to discuss today is that what are the consolidation adjustments. Okay, till now we have understood about the parent auditor, responsibility of the parent auditor, responsibility of the management. We have discussed about the concept of the consolidated financial statement, audit of it. Okay, now we are going to understand more on the adjustments that are required to be made for the purpose of consolidation. Okay, now see, when I talk about the adjustment, there are two type of basically adjustment with respect to the consolidation. One is the permanent adjustment, and second are the temporary or the current adjustments. Can anyone tell me what are the permanent adjustments? Anyone? Permanent consolidation adjustment. What are these adjustments? Anyone? So let me tell you, the permanent consolidation adjustments are the adjustments where you determine the amount of goodwill or capital reserve when you acquire. Second, you basically determine the amount of equity attributable to the minority and non-controlling interest. Okay. See, remember we have seen already the minority in the division 1 and the non-controlling interest in the division 2. You need to determine that amount. And in order to determine that amount, you need to, at the time of acquisition, you need to perform some adjustments. You need to calculate what is a non-minority, non-controlling interest. And on the basis of that only, you will be able to decide, okay, this is the non-controlling interest or this is the minority. And accordingly, you will, then disclose that particular amount in your financial statements year on year. That is permanent. That means once you decide equity attributable to the non-controlling interest or the non-controlling interest portion, every year that is going to remain same. That's why it is permanent. Once you decide goodwill, it is going to remain same because it's acquired under the acquisition. It is going to remain same. Okay, so that is the permanent consolidation adjustments. Now, when I talk about current consolidation adjustments, okay, this is permanent. Determination of the goodwill and capital reserve, the permanent. Determination of minority or non-controlling interest, permanent. Now, when I talk about the current period consolidation adjustments, can anyone give me some example of that? Current period consolidation adjustments. Anyone? No? So when I talk about current period consolidation adjustments, these are the adjustments we have already seen. Related party transactions, intergroup interest paid, or intergroup transaction, intergroup amount paid. Then unrealized profit on the sale and purchase of assets, okay, between the group entities or subsidiaries and the holding. Then unrealized profit, which is there with respect to the intergroup transaction. Then intergroup loans. So there are various intergroup transactions that may happen between the company, okay, between holding and subsidiary. Now, what are the adjustments for that? So when you do a consolidation, you need to adjust, you need to remove those transactions. Okay, you need to make sure that you eliminate those. Otherwise, you will be double counting a particular transaction. So you need to eliminate those particular transactions which are common, which are between the intergroup entities which are being consolidated, and accordingly, basically, you need to perform the consolidation. Okay. Now, these permanent or these current items which change from year to year. Now, today I may have a sale of X amount with a particular subsidiary. In next year, I may have a Y amount. Okay, I may have a Y amount of sale with a particular subsidiary. So year on year, I will change the current period, current consolidation amounts. So year on year, these amounts will change, and accordingly, that's why they are told as they are known as a current period, because year on year the numbers of these transactions will change. In next year I may not have any sale with my subsidiary, or in one particular year if the sale is 1 lakh rupees, so in next year it can be 2 lakh rupees. Depends upon what kind of transaction it is, and year on year there could be multiple factors which may determine the amount of that particular transaction. So accordingly, year on year, this is required to be evaluated, identified, and these are required to be eliminated. Okay, these are required to be eliminated. Now, when I say required to be eliminated, say there could be multiple things with when I talk about elimination. And how do you identify what you need to do with the consolidation? Like, is there any guidance or is there any standard on what activities are required to be undertaken for the consolidation? Anyone? We have discussed this, the guidance or the standard on the consolidation. Anyone?
Sir?
Yes.
Sir, actually your PPT or PDF is not seen your reserve.
Is it not visible? It is not visible?
Yeah, it's visual now, sir. Yes, sir.
Okay. So, is there any guidance? So, yes, there is a methodology provided in Ind AS 110. If we are talking about Ind AS 110 has that methodology. For example, how to perform the consolidation procedure. There is an entire guidance given, like combine the items of assets and liabilities and equities and income, offset, eliminate the carrying amount of the parent investment. Okay, and Ind AS 103 explains how to account for any related goodwill. Then eliminate in intra-group assets, liability, equity, income, expense, cash flow. Okay, apply Ind AS 12 on the temporary differences that arise from the elimination of profit and loss resulting from intra-group transaction. All these things are already given in the Ind AS 110 that I'm talking about. Okay. Now, if this is given under the Ind AS, that means management is required to follow this. That means management, when they will follow, you have to audit as per the Ind AS 110 that these adjustments are appropriately accounted for or not. Okay, so these adjustments are appropriately performed or not, and accordingly you need to see that whether the consolidation is done appropriately or not. So you need to understand from where what you are required to check. Like if they are performing the elimination, why we are required to perform the elimination, where it is written. You need to be aware of that. Okay, just because I'm saying that remove the intra-group transaction, where it is written. Just because I'm saying provide the India's 12 impact on this elimination of the intra-group profit, where it is written. India's 110 provide the reference for that. So you should be aware how the consolidation happens, so that you will be then able to audit the consolidation. Okay, then comes a very, very important part that we already look from the perspective of the standalone audit, but the same is required to be reviewed now from the perspective of the your consolidated audit of a consolidated financial statement. So can you tell me certain examples of specific matters that as an auditor we already see from the standalone financial statement perspective? And for your reference or for your hint, we have a standard on auditing also on that. We have an essay on that, a specific area, very important area that you see from the perspective of standalone financial statement that is also applicable to the consolidated financial statement, apart from whatever we have discussed. Anyone? And that is very important here. This particular area is very important. So the area is subsequent events, which is the essay which talks about subsequent events. Anyone? Essay which talks about subsequent events. No? I think you guys have not gone through the study material and you have not gone through the standards itself. That's basic. Yes, very good, Radha. I'm talking about standards on auditing on subsequent events. Okay. So when I talk about subsequent events, that is covered by SA 560. Basic SA 560. Now, why it becomes very important when we are talking about consolidation? See, when we are talking about consolidation, why SA 560 becomes very important? Reason because you have a different audit reports and the financial statement with you. Again, I will take the same example. Let's say we have multiple entities. Okay. For this particular example, I'll take 4 entities. Simple structure. This is holding company, subsidiary 1, subsidiary 2, subsidiary 3. Now, holding company. Okay. Like we are the auditors. Let's say HN company are the auditors. Subsidiary company, again, YN company the auditor. Subsidiary 2, which is outside India. Let's say this is outside India, X country. And this is in the Y country. Okay. Now let's say subsidiary 1 audit report. Now I'm talking about the date of audit report. Okay. Date of audit report and the period of financial statement. That's where the matter becomes very important to understand. Period of financial statement. So let's say the date of audit report for YN company, they issued on 30th 6, let's say 26, and it is for the financial year 25-26. Not a problem. We know how to apply SA 560. Let's say S2, there is some foreign auditor, FN company. Okay, and again, this is also outside India. So here, this is also being audited by FN company. Now, the period that was adopted by the S2 subsidiary 2 was calendar year 25, and the audit report was issued on 31st of Jan 26. The financial year, or the period that was followed by a country S3, oh sorry, subsidiary S3. Let's say it was October to September, usually the way it is done in the US. Okay, so October to September 26. Now, again, the due date for issuance of the report here will be in the next year. So what I will do is I have to take up the audit report of a period before, which is issued for the October 24 to September 25, and then I will ask the auditor to do the rest of the portions audit. So first here, the audit will be performed till September 25. So I will get the report of September 25. Let's say that is issued on 30th 9/25 audit report for October 24 to September 25 period. Okay. Let's say this is a scenario. These are the reports that I have received. Now, how will you apply the subsequent events here? What is the period that you will consider from the date of audit report till the date of, from the date of financial statement to the date of audit report? Let's say XN company is planning, now this is the tentative date I'm talking about, XN company is planning to sign the consolidated financial statement on 31st 8/26 for the financial year 25/26. Now the question comes is, FN company has already considered this particular financial year. They have issued the date, they have issued the report on this particular date. That means subsequent event from the September 25 to my date of audit report, that is in September 25 itself. They all are considered here from December to January. Okay, from the date of financial statement to the date of signing of audit report. Here, from the close of financial year, that is 31st March 26, till the date of signing of audit report, everything is considered. But I, as an auditor, as a principal auditor, needs to consider all events till this date. This is the tentative date of audit of, signing of audit report. That's what SA 560 says, yes or no? So subsequent events is something from the close of financial year to the date of signing of audit report. Now they can be adjusting, they can be non-adjusting kind of things. So will you ask the auditor of FN Complex Subsidiary 3 to consider the subsequent event till 31st 8/2026? Or what will be the period of subsequent events? That's where it becomes very important in consolidated financial statement to understand what are the subsequent events. Okay. So first of all, a basic understanding, subsequent events. Again, there are two types of subsequent events. One that require adjustments. Okay. Now the conditions and evidence about those events were existing at the date of financial statement. Second, they are non-adjusting. That means there were no conditions or evidence of that particular event on the date of financial statement. Okay. So if there is no evidence, it is non-adjusting. If there is evidence, that is adjusting. And I need to apply as 560. That means I need to understand, was there any evidence available from the perspective of to understand the significance of the event and the impact of the event on your consolidated financial statement also. Okay, so now basically, let's say, for example, from the date of the consolidated financial statement till the date of the audit report on the consolidated financial statement, I need to consider all the events. So by applying the concept of SA 560, subsequent events for me will be from the date of CFS to date of signing of audit report on CFS, whether it is in the period of financial statement of any subsidiary or not. So what is the subsequent event for all these subsidiaries is over here will be subsequent event is from 31st 2026 to the date of tentative signing, which is 31/8/26. This is the period I'm talking about as a subsequent event period. All the events happened in this particular period are required to be considered whether adjusting or non-adjusting. Now, in case of subsidiary 3, if you see, this period is after the audit report of the subsidiary 3. If I talk about this, this is after the audit report date of subsidiary 3. Yes or no? Because subsidiary 3 audit report was 39/2025. That September 25 period got over, the audit report was signed. Let's say I'll extend a bit. Usually doesn't happen like this, but let me extend a bit. So let's say the date was 31st October 2025, after a month. Okay. So again, that is also after the date of audit report of subsidiary 3. So here, what auditor will be required to do? So principal auditor will provide instructions to consider events between this particular period, and now these instructions will be given to the component auditor. This is the role of the principal auditor. He needs to provide these instructions that, okay, what you are required to do. And this is as per SA 600. I'm not saying something new. SA 600 says this, that principal auditor has to coordinate with the component auditor, and like the principal auditor is required to make them know that how their work will be used. Okay. How the work of the component auditor will be used. That is something the principal auditor is required to do. And that is what you are also required to do in the case of subsequent events. It's not something new. Okay. So this particular part, like, this is something very important to understand, because again, subsequent events, they will change from year to year. It is not something that they will remain same. Today, whatever subsequent event is there, not necessarily that it will be there in the next year. So you can say that subsequent events and their consideration is nothing but a current period consolidation adjustment also. Okay. So subsequent event is nothing but a current period consolidation adjustment also for the auditor. Yes or no? And accordingly, you need to see that what will be the impact of this current period consolidation adjustment. Then, as we have already discussed about the gap, local gap conversion. So you need to make sure that, components local gap to the your Ind AS conversion is done by the management, and you have to audit that. Okay, you have to audit that. Identification of the non-controlling interest. And equity attributable to the minorities and non-controlling interest. Again, you need to see from the point of view that is there any impact in the current year on the non-controlling interest. Adjustment of the deferred tax on temporary differences as per India's 12. Again, part of India 110. India's 110 says that you should look into this, and as a management is required to look into this, and you are required to audit this. Clear? Pretty much straightforward that whatever current period consolidation adjustment management is required to make, you are required to audit those things. And you need to understand that those are basically in line with the applicable financial reporting framework. Now, again, one important point that I will highlight from the India's 110, okay, is that there are multiple things that India's 110 provides. Okay, one of such thing is uniform accounting policies. India's 110 says that if a member, okay, of the group, that means a component, uses accounting policies other than those adopted in the consolidated financial statement, okay, for the like transaction and the similar, appropriate adjustments are made to the group members' financial statement in preparing the consolidation. That means you need to make sure that these adjustments are also being done, to align the accounting policies. So to align the accounting policies, management is required to pass adjustments, and you are required to make sure that you audit those adjustments and they are in line with the account policies being followed by the group or the parent company in this scenario. So that is very important to understand. Again, India's 110 and rest of the India's provides that how to particular, provide for a particular transaction in case of the consolidation wherever it is applicable. So I'll not go much in detail in case of the, the adjustments that are required by the Indias, but that is something you should be aware of so that you will be able to audit it. Now, any doubt till now on this part? Any doubt? Any doubt till now? No? If no doubt, let us see some questions on this particular topic so that we will be able to understand in much more detail now. Okay, let us take some questions. Okay, so this is one of the MCQ which is part of a case study. Okay, we will see the case study bit which is relevant to the MCQ, and then we will discuss the answer of this. This is the particular case study. I'll just zoom in a bit. We will read a few of the points from the case study, and accordingly we will discuss the question. So basically the case study is that CKS Limited is a listed nationalized bank, okay, whose face value per share is this, having its operation across India. Now, CKS Limited has acquired another bank called Royal Limited. While finalizing the books of accounts, some adjustments were made to give effect of the merger. Now, these adjustments were related to the determination of the goodwill of 2.5 crore, determination of amount of minority interest of 60 lakhs, and some intra-group transaction adjustment of 17 lakhs were also made. Another adjustment which was made was harmonization of the accounting policies of both CKS Limited and Royal Limited, which was 34 lakhs. Okay. Now, let's go and first let's read the question. The question is, which of the following statement is true as per the given situation? For giving effect of the merger, permanent consolidation adjustment of 361 lakhs were there. For giving effect of the merger, permanent consolidation adjustment of 344 lakh, and for the current period consolidation adjustments, okay, of 17 lakhs was made. For giving the effect of merger, permanent consolidation adjustment of 310 lakhs and current period consolidation adjustment of 51 lakhs was made. For giving the effect of merger, permanent consolidation adjustments of 327 lakhs and the current period consolidation adjustment of 34 lakh were made. So, based on the given scenario, tell me which are the permanent consolidation adjustment and which are the current consolidation adjustments. Let me go back to the question. Okay. Now, these are some adjustments. Tell me what is permanent, what is current period. What is basically you think is permanent and what is current? Anyone? What is the permanent portion and what is the current portion? Okay, Radha, very good. Come on, quickly. Pretty easy that we have discussed now. It is pretty easy. What is permanent and what is current in this portion? Very good, Kanaya. Very good, Radha. Yes. Can you tell me also the amount? Can you also tell me the amount? So, in this particular scenario, okay, in this particular scenario, see, whatever we have discussed, goodwill is basically permanent one. Determination of the minority interest is permanent one. Goodwill is given 2.5 CR. So I have converted into the lakhs, okay, which is 250 lakhs. Minority 60 lakhs, total 310. I can say it's a permanent one. Transactions adjustment, intra-group transactions. Now, intra-group transaction, as I told you, it will change year on year. 17 lakhs. It is temporary, current. And another adjustment was harmonization of the accounting policies. It will also change year on year. So it is 34, another total 51. So current is 51. Now let's see the answer. Okay. If we go back, so option number 1, entirely permanent. Not correct. Option number 2, permanent 344. No, we have a 310 permanent. This is incorrect. Option number 3, permanent 310, current 51. Matches. C is the correct answer. D, permanent 327. Incorrect. And current, your 34. That is also incorrect. So D is also incorrect. So correct answer is 310 and 51 with the C option. Clear? Clear? Any doubt? Okay. Now, let us see one more question on similar lines, and very good question, I would say. So, let me bring the question. Okay, very important question. PKT Limited holds 51% equity in AB Limited and 61% equity in XY Limited. There are various information and explanation which are disclosed by the respective company in notes to their financial statement. At the time of consolidation, management of the PKT Limited has consolidated all the information and explanations disclosed in the notes as well. The principal auditor is of the view that only those information and explanation should form part of the notes to the consolidated financial statement which are relevant at the group level. Please mention any 5 aspects given in the note to the separate financial statement of the parent and the subsidiaries that need not to be included in the consolidated financial statement. Again, you are need not to be included. I'm not saying which are required to be included. So you need to answer what is not required to be included, which may be there in the standalone. But I'm not required to include that in the consolidated financial statement. Anyone? Anyone? Okay, Kanaya, very good. What else? Come on, quickly. What are that relevant part? Very good. Yes. What else is required? Not required to be disclosed. Very good, Kanaya. Anyone? Okay. Very good. Yes, Radha. Very good. See, from where this particular item is coming, that is very important. We need to understand that. Okay. Basically, see, what is the scenario is there is no particular standard or accounting standard or any other standard which requires and which specifically disclose this information or do not disclose this information in your consolidated financial statement. Okay. Neither Ind AS 110 nor any other standard says that you are not required to disclose this. But standard always, or let's say circulars always specify what you are required to disclose. Okay. So always the standards and the circulars and the law provides what you are required to disclose rather than what you are not required to disclose. And accordingly, we need to understand that what are the things that we are required to disclose in the separate financial statement, and what are the things then we are not required based on the given scenario, based on the given circular, by inferring that this is the information that is not required to be disclosed. And the answer to this question is also there in your study material, so we will see from the study material itself. It is on the page number 13.22. Okay, 13.22. Now there is section 129.4. Remember section 129.4 we have discussed in previous session. What is section 129.4? That talks about that the provision of the act shall apply to the preparation, adoption, and audit of the financial statement of holding company. They apply, shall apply in the similar manner to the consolidated financial statement and referred into 3. Okay. So if there is anything which is applicable on the holding company's financial statement, that you are required to apply to the consolidated financial statement also. But there is a circular, MCA circular. Okay, MCA circular of 39 of 2014. Now what this circular says, this circular basically, if I talk about this circular, is clarifies for the what you are required to do for the purpose of consolidated financial statement. So this circular basically says that if there is anything which is already been specified, okay, in the standalone financial statement. For the purpose of repeating the disclosure, do not disclose it again and again. Okay, so you can avoid disclosing that if that is not relevant from the consolidated financial statement purpose. Okay, just for the purpose of repeating the disclosure, you should not do that. And this is the particular circular that I'm talking about. What it says that, okay, that applicable accounting standards do not envisage that a company, while preparing its CFS, merely repeats the disclosure made by it under the standalone accounts being consolidated. Okay. In the CFS, the company would need to give all their disclosures relevant to the CFS only. Relevant to the CFS only. Just for the sake of disclosure, do not repeat the things. That is a circular that we are talking about, 39 of 2014. That means, let's go to the Schedule 3. Now, Schedule 3 specifies certain additional items that are required to be disclosed. So, additional items a company shall disclose by the way of notes. Okay. In addition to the aggregation of the income and expenditure. And what are these? Something that I'll show you. Now, for example, over here, CSR. If there is something CSR applicable to the standalone, and if all the subsidiaries are outside India where the CSR is not applicable, or because of any reason the CSR is not there, for the purpose of only such repetition, you are not required to repeat the disclosure. Okay. Then foreign exchange reporting in the foreign exchange currency. Okay, foreign exchange reporting gain and loss, or expense in the foreign exchange. All those things, these are not required to be disclosed again and again. Why? Because if you are converting basically financial statement of a company which is outside India into the local currency, for them everything is the foreign exchange. Okay, everything is in the foreign exchange. Then for that particular purpose, you should not repeat that. You should not again show that, okay, what is the expenditure done in the foreign exchange or foreign currency. Basically, there is no point of doing that. Then undisclosed income. Now, companies outside India, to them undisclosed income might not be relevant because they are not part of the Income Tax Act. So again, is it relevant from the purpose of the consolidated financial statement? You need to understand that. So all these things you need to understand, that what is relevant from the purpose of the consolidated financial statement. Okay, whether it is relevant or whether it is because of only and only you can say that it is because of we have a particular holding company and rest of the companies are outside India, so it is relevant from that perspective. So you need to understand from that perspective, and you need to answer the particular area from that perspective. Okay. Again, so these are some items which are given in the study material also, that sources from which bonus shares are issued, disclosures of unutilized monies out of the issue which is there, then disclosure required under MSME. Now this MSME disclosure may be relevant from the Indian company, holding company, Indian holding or Indian subsidiary, might not be relevant from the foreign companies. They don't have the concept of MSME over there. Okay, again, a statement of investment, separately classifying trade investment and other investment, value of imports calculated on CIF basis. Now, for Indian purpose, for the Indian holding company, you have an import. But what if your subsidiaries are outside India? How will you calculate the import? Is it import? Okay. Then expenditure in foreign currency. Now, foreign currency for the purpose of India is anything in the US dollar or Singapore dollar. What if my entity is in Singapore? How will you determine the expenditure in foreign currency? Will you classify entire expenditure, whatever is done by that particular entity, into the expenditure into the foreign currency? Again, value of all imported raw materials, amount remitted during the year in foreign currencies on account of dividend. earnings in foreign exchange, okay, export of goods, royalty, know-how, interest, dividend. These are relevant from the perspective of standalone financial statement, not from the perspective of the consolidated financial statement. And when even they become irrelevant when you have most of the subsidiaries outside India. So accordingly, you are not required to repeat for the sake of complying with the that particular disclosure under Schedule 3. Okay. So these are certain items that that basically you are required to not to include in the consolidated financial statement as a management, and as an auditor you need to verify this. Okay, that was our question. Which items you need to give any such 5 items which are not required to be included. So any 5, but there is a list which is already given, so you accordingly you can provide the answer. Okay, any doubt?
Harshad, I just want to make some small announcement.
Yes, ma'am.
Dear students, since portal is live, so there'll not be any Zoom link shared to you. You can directly join through the BS Knowledge portal as you were joining earlier. So you can join in the same manner. Thank you. You may continue, Harshad, sir, please.
Thank you. Yes.
In the meantime, also you can inform this, okay, before the break and after the break,
Sure,
so that
ma'am.
they can get the idea that the Zoom link is nowhere will be shared, and they can use the same platform.
Yes,
Thank you.
sure. Okay. Any doubt? So again, just to repeat the announcement, please join through the BOS portal. You need to log in onto the BOS portal through your credentials. Go to the section for the LBC. Okay. Over there, click on this particular section, and then on the basis of that, you will see an option of join Zoom. And if you click that, you will be able to join the session. So you need to join the session through the BOS portal by logging into the BOS portal. So there is one question: do we need to harmonize the foreign exchange in CFS? Then why expense of foreign currency is excluded? Can you just like can you just elaborate more, Radha? Or also, if you can unmute and ask the question in more detail if possible. I think there is some issue with the part where you might not be able to speak because of some technical glitch on the sound. But again, okay, so we do, yes, we do need to harmonize the foreign exchange, foreign currency and foreign subsidiaries financial statements into the local currency that is there. Then why the expenditure of foreign currency is excluded? See, let's say you have a subsidiary in Singapore. For the harmonization purpose, you will translate everything into the local currency. Now, when there is a disclosure under the, let's say, your Schedule 3, okay, there is a disclosure that provide the basically, expenditure in the foreign currency. So you need to provide whatever expenditure you have incurred in the foreign currency. Now, if I provide expenditure into the foreign currency, okay, foreign currency means whatever is there that you have expended, you have paid into the foreign currency. Okay, the entity has paid into the foreign currency. Now, the entity which is there in the Singapore, the subsidiary company, that entity has paid everything into the foreign currency. That entity has paid everything into the foreign currency. And accordingly, how will you then, will you determine all the expenditure of that particular entity, okay, as as the expenditure incurred into the foreign currency? That would not make sense at all. Okay, so you need to understand, is it relevant from the CFS purpose or not? I hope I have answered your question. Absolutely, it will create unnecessary hassle and it will create unnecessary complexities. Plus, for example, let's say there are, amount which are you are required to report, amount which you have remitted outside India. Okay, now if there is an amount which is remitted outside India, from the holding perspective or the Indian entity perspective, from the perspective of the foreign subsidiary, everything is outside India, and it will become a very big difficulty also in that sense, to report that amount. Plus also harmonization from the perspective of schedule 1 and schedule 2. Again, like very rare scenario, but again, if there is something, additional disclosure which is not there in the schedule division 2 of the schedule 3, okay, then you are not required to disclose that, because the CFS will be prepared as per the schedule 3 division 2. So if something is not there in division 2 of schedule 3, you are not required to disclose that, even though it is there in the subsidiary. Sir, what is if the foreign expenditure is done by the principal entity? Now, you already disclosed that in your standalone financial statement. So you are not only preparing consolidated financial statement, you already disclosed that in a standalone financial statement. Then why, for the sake of repetition, repeat again in the CFS? I hope I have answered, Kaniya, your question also. Any doubt? Okay. So these are certain points that are there, okay, that are not required to be disclosed. There is one more interesting question that I would like to take on the consolidation part. Very interesting question. Okay. R Limited is a listed company engaged in the manufacturing of round bars. The company is having investment in the following components: 2 subsidiaries, 1 joint venture, 2 associates, 3 business entities under common control, interest in asset, liability, revenue, and expense in a joint operation with 1 company. Okay. R Limited and its all components are required to present their accounts as per the Ind AS. While preparing the consolidated financial statement, R Limited consolidated its components on a line-by-line basis by adding together the like items of asset, liability, income, expense, and the cash flow. R Limited seeks your advice on the accounting treatment in respect of the above components for the consolidation in accordance with the company's Indian Accounting Rules 2015. Again, on the consolidation part, like what and how the R Limited should approach to this consolidation. Here, you are not only required to provide the answer from the perspective of the audit, but here you need the understanding of the financial reporting framework. You need the understanding of the Indian accounting standard rules, accounting standards, Ind AS. That knowledge plus the knowledge of the audit, you need to apply that, and accordingly you need to answer the question. So consolidation is not just applying the knowledge of audit, it is the understanding of the financial reporting framework also. Then only you can audit that. So tell me, in this scenario, how the consolidation is required to be done? Simple question. Trust me, it is very simple. Anyone? Okay, very good, Kanaya. Yes. What else? How the R Limited should approach in this scenario with respect to the consolidation? See how you have to apply the knowledge of financial reporting when you have to answer a question from the audit, because audit is done for the financial statement where you should have the understanding of the financial reporting framework. Come on quickly. How R Limited should perform or should approach to this consolidation? How they should perform this consolidation? Anyone? It is, trust me, it is pretty much easy to understand in this scenario. If you have gone through a basic of the also consolidation, you will be able to understand. No? See, first of all, is every entity a subsidiary? In our given question, is each and every entity a subsidiary? There are two subsidiaries, one joint venture, two associate companies, okay, three business entities under common control. Now, what accounting standard or Ind AS you will apply over here? Can anyone tell me which Ind AS you will apply over here for the consolidation? Anyone? Ind AS that you will apply for the consolidation. Okay. Someone said Ind AS 110 for the consolidation. Yes, absolutely correct. Ind AS 110 for the consolidation. Will I apply Ind AS 110 for the consolidation for joint venture also? Will I apply Ind AS 110 for the joint venture also? Yes, no. Very good, Radha. Absolutely correct. Very good, Kanaya. If not, then what I will apply? What I will apply? Let's discuss from the as of now perspective from the Ind AS. So if I talk about from the perspective of the Ind AS subsidiaries, let's say yes, I may apply Ind AS 110. Joint venture, don't you think I should apply Ind AS 28, investment in associates and joint venture? Yes or no? So the standard Ind AS 28 is applicable to all the entities that are, in control of, joint control of, or a significant influence of the investor. Yes or no? What I will apply for the associate? What I will apply for the associate? Anyone? For associate, again, I will apply Ind AS 28 because the objective, if you see the Ind AS 28, what is the objective of the standard? Okay, accounting for investment in associate and to set out the requirement for application of equity method when accounting for investment in associate and joint ventures. Again, same. Three business entities under common control. What Ind AS I will apply? What Ind AS I will apply over here? I'm talking about common control. Anyone? Common control, jointly control, joint operation. Which Ind AS is there? Very good, Radha. No. Ind AS 111, have you heard about this? Joint arrangements. What it says that jointly controlled entity arrangements. If there is a joint arrangement, okay, over there, I will apply India's 111. So objective of India's 111 is entities that have an interest in arrangement that are jointly controlled. That will be applicable over here, joint arrangements. Okay. So India's 111 will be applicable for the joint arrangements. Now, accordingly, I will apply that particular India's in this scenario. So, India's 111 plus if required, I may need to apply. Okay, I might need to apply India's 112, disclosure of interest in other entities, if relevant, if required, based on the scenarios. I'm not saying might be entirely applicable, but if it is applicable, I need to apply that also, India's 112, disclosure of interest in other entities. Okay, so entity may require to disclose that the nature and risk associated with interest in other entities with respect to the disclosure. Okay, that is also applicable. Now again, there are other standards which might be applicable over here. Okay, which I need to consider for the purpose of disclosing and performing the relevant accounting for these kind of transactions. So basically, all these things I'm required to consider, not only India's 110. Okay, India's 110 is just one thing that we are talking about. There are multiple NDAs that are applicable, and accordingly, all the transactions, all the entities are required to be disclosed in that particular way. Okay, so if in this particular scenario, applying India's 110, adding line by line is not appropriate. Is not appropriate. There is one more NDAs that I need to think of. It might be applicable in this scenario. Can anyone tell me which NDAs I'm talking about? There is one more NDAs left, and that is very important NDAs, which is related to your permanent consolidation adjustment. Permanent consolidation adjustments. Anyone? Absolutely correct, brother. NDAS 103. Yes or no? NDAS 103 helps you to identify the non-controlling interest. It helps you to recognize and measure the goodwill that is acquired in the business combination. Okay, so that is very important in NDAS. You need to understand how much non-controlling interest is there, how much goodwill is there, and accordingly you need to account for it. So the line by line consolidation, which is given in this question, that while preparing consolidated financial statement, are limited, consolidate its component on line by line basis by adding together like the items of this is incorrect. So when you have to write the answer, first of all, you need to explain what are the relevant standards, okay, NDAs basically, which are applicable in this scenario. And then you explain in the given scenario, these are the entities where different NDAs will be applicable. Applying line by line is incorrect, and accordingly the rest of the NDAs are required to be followed. This is how you are required to write the answer for this question, and I'll show you the answer. See, over here I will mention the relevant standards NDAs, like India's 110, India's 103. Okay, then NDAs again, various part of like elimination of intra-group transactions, business combination with respect to pooling of interest, and all these things which are there in India under the India's 103. Then equity method under India's 28 for the investment in associates and joint ventures. India's 111 for the joint arrangements. So all these Indias you need to specify, and accordingly you need to say that okay, line by line consolidation in this given scenario, okay, line by line basis of adding together is not correct, is not appropriate for all the entities. Okay, not correct for the other components, and you need to follow the rest of the standard for other components. This is how you should write the answer. Clear? Any doubt? Yes, no? No doubts? Okay. If no doubts, let's discuss something more, some more questions on the similar topic. Because here, now we need to understand from the auditor's perspective also, not from the only perspective of the consolidated financial statement. So one good question. MK Electronics Limited is a listed company with 8 subsidiaries spread across various states. The financial statement of MK Electronics Limited are audited by CA Amar, the principal auditor. CA Amar relies on the work of other auditors for auditing the financial statement of subsidiaries. You are required to, very important part, now understand this. Explain the procedure that CA Amar will perform to obtain sufficient and appropriate audit evidence to ensure that the work of other auditor is adequate for his purpose. We will go first with this. Now, what procedure CA Amar should perform to ensure that the work that he has the sufficient and appropriate audit evidence to understand the work which is performed by other auditors is appropriate for his purpose. We have discussed this. Trust me, it is pretty easy. We have discussed this multiple times. How CA Amar can ensure that he has sufficient and appropriate audit evidence, okay, to ensure that the work which is performed by the other auditors is sufficient or adequate for him. Now, if we go for our example, let's say in this example, how Action company can ensure that the work performed by FN company is adequate for them. Simple. Quickly, anyone? Okay, Kanaya. Very good, Radha. Very good. Anyone else? Very good. Yes. So, see, when you are required to write an answer from the perspective of, you need to understand from which perspective you need to write the answer. Okay. So remember, in the last session, we also discussed that understand either you are writing the answer from the perspective of the standard financial statement, auditor's responsibility. What is your perspective to write the answer over here? What is required and what is asked? Here it is asked the explain the procedures. This is not, it is not written that give the example. Give the example of procedure. No, it is not written like that. You are not asked for the examples. You are required to explain the procedure. Remember, what is asked, you need to understand. Like then only you will be able to write the answer. So if someone asks, okay, give the examples of the procedure that CA Amar should perform, it's a different thing which is being asked. If it is asked that explain the procedure, We are not asking the example. You need to explain the procedure that will help CA Amar, okay, to ensure that the work of other auditor is adequate for his purpose. Instead of giving example, you need to explain. So if I talk example will be understand the group structure. No, that is an example. Okay. Example is that, okay, what I will do is that there is a risk. Okay, I will perform the additional testing to get the work, to get the sufficient and appropriate audit evidence, that I may perform the risk assessment on the subsidiary. I may visit the subsidiary. I may ask details from the, management of the subsidiary. Example. What you need to do is you need to explain, and that is you need to explain that the other auditor's work is adequate. So for that, we'll go to the SA 600. Okay. Simple. In order to understand that the work performed by the other auditor is appropriate for you, you need to, okay, perform this particular procedures. So when using the work of another auditor, the principal auditor should ordinarily perform the following procedures. Advise the other auditor of the use that is to made the other auditor's work, like how I will use your work, okay, how I will use your report. Make sufficient arrangement for the coordination of their efforts at the planning stage of the audit itself. Sharing the materiality at the start of the audit is an example of the coordination. But you need to explain. When I say explain, you need to explain that make the arrangement for the coordination. Okay. Providing them the materiality at the start of the audit, providing them which area to audit is an example. The principal auditor would inform the other auditor of matters of such areas requiring special consideration. Okay. Or procedures for the identification of intercomponent transaction that may be required to disclose, and the timetable for completion of audit. So as a principal auditor, I will already provide him what are the special areas. Okay. Procedures for the identification of the intercomponent transaction, disclosures that I may require for that additional disclosures, timetable for the completion of audit. Okay. Sufficient arrangement for the coordination at the planning stage, advise how the work and report will be used, plus advise the other auditor of the significant accounting policies, auditing and reporting requirements, like obtaining representation to comply with them. Because at the end, we have to comply with the group accounting policies, uniform accounting policies. I have to audit as a principal auditor. I need to comply with my auditing standard. So I need to advise the component auditor that what are the significant accounting and auditing standards that they are required to follow. Okay, reporting requirements they are required to look into, and they need to obtain the representation with respect to that. Okay, this is how I will make sure that the work which is performed by another auditor is adequate for the principal auditor's purpose. Okay, and this particular advice or this particular instructions will differ from component to component. So accordingly, instead of giving example, explain the procedure which is applicable to all the other auditors. This is how you need to write the answer for that question. That is, explain the procedure. This is how you are required to explain the procedure. Clear? Any doubt? Yes, no? No? Okay. Now, if for every component the instructions differ, then won't it be a headache for the main auditor? That's where you have something called as a group instructions. Okay, group auditor instructions, a detailed document that is prepared before you commence the audit. Like, like after doing the understanding of the entity and after doing all the relevant procedure and before, other auditors start their work, you make sure that you prepare that document and accordingly you share that document with each and every auditor. Okay, then only they will be able to perform their respective tasks. Otherwise, yes, it will be a scenario where basically none of the auditor will be aware that okay, what they are required to do, and they will do their audit by their own, and at the end will be the scenario is that the audit that has been done by them will not be sufficient for you. Okay, very important that this is known as the group instructions. Any doubt? No? Okay. If no doubt, let's understand something further, a very important part. Now we will understand that how the consolidated audit of a consolidated financial reporting impacts the audit report. So we will go a step further and now we will go to the reporting part. See, we started with the planning. Then we went to the execution. Okay. That okay, how the execution will differ for the consolidated financial statements audit. Okay. Now we will take a step further and we will understand how basically the reporting will differ. We will see something different from the reporting perspective. Okay. So see, when we are talking about reporting now, when we are talking about that reporting will happen over there in the consolidated financial statement, there are few things that differ, that will change with respect to the standalone and the consolidated financial statement. Let me share the financial consolidated financial statement so that we can discuss further. Again, I would request not to focus on the name of the company as of now. So let us go to the consolidated financial statement section. And again, this is a publicly available data, so you can go and check. Okay. This is the consolidated financial statement and the audit report on that. Okay. Some changes that we will notice now. So remember in the last session, on the first session on this particular topic, in the last session, we discussed about this particular part, other information, opinion, basis of the opinion, key audit matters. These are same. These will remain same. But what will differ then? The thing which will differ, there is a part which is known as the other information. Okay, other info or other matter paragraph, very important part. So let me show you the other matter paragraph. Sorry. I think it is between pages missing in this. That's why I am not able to locate. I'll show you another example of the audit report. Don't worry. I have another one. I think there is some omission in this. There is, I think, a page missing. That's why I'm not able to locate that other meta paragraph. Not an issue. Let me open another one. So we will now look into a particular audit report, okay, where basically kind of, other matter paragraph is there. And meanwhile, can anyone tell me under which standard you are required to report the other matter paragraph? Anyone? Under which standard you are required to report the other matter paragraph? Very good, Radha. Yes. Anyone else? Under which standard you are required to report the other matter paragraph? No? So usually the standard is SA 706, where you are required to report the other matter paragraph. Okay. Now, there is SA 600 requirement also with respect to the other matter paragraph that we will understand now. Now, SA 600 requires to report something additionally in the other matter paragraph. And that is very important, and that is something we need to understand. So, just a minute, let me open that. So here it is, the another audit report. Again, this is also available in the public domain, so do not focus on the name of the company as of now. We will go to the consolidated financial statements and the audit report on that. Okay, over here we have a financial statements, consolidated F30. Let me see if I can go from here. No, I need to go to that particular page. Let me go. Okay. So now I have this. This is the consolidated financial statement and the audit report on that. Okay. Again, the consolidated financial statement. Again, similar. Everything you will find everything same. You have an opinion, basis of opinion, key audit matters. Okay. Other information paragraph. Other matter paragraph. Okay. This is something we are required to report as per SA 600 plus SA 706. Additional reporting. This is very important, additional reporting. Now, what is this reporting about? This other matter paragraph. We will read first and then we will discuss on this and we will understand where and why we are reporting this. Okay, and we will bifurcate the entire paragraph into sections. So, if we read this, it says that the standalone and consolidated financial statement and financial information of the 13 subsidiaries, including the interest in the joint operation as applicable, reflect total asset of this CR, this much crores, net asset of this much crores, and total revenue, total comprehensive income, okay, comprising of profit and other comprehensive income, and the net cash flow of this much crore for the year ended date on that date has been considered in the consolidated financial statement. So first of all, we are identifying 13 subsidiaries, and for that we have specified total assets, net assets, total revenue, total comprehensive income, okay, net cash flow that has been included in the consolidated financial statement. Okay, then we will read further. The consolidated financial statement also includes group share of total comprehensive income of this much amount, which is nil, and this much crore for the year ended this as considered in the consolidated financial statement. So group shares of total comprehensive income, which is there. in respect of one associate and two joint ventures respectively, whose financial information have not been audited by us. See, for the associates, we do not add line by line. Okay, we might consolidate in a different way. So for that, we say that the group shares of total comprehensive income, okay, of this and this INR for the year ended 31st March is basically uh, included in the consolidated financial statement, which is in respect of one associate and two joint ventures, which is not audited by us. Remember, this is very important. Not audited by us. Okay. Then we go further and we read that the financial statement and financial information of these subsidiaries, associate, joint ventures have been audited by other auditors whose reports have been furnished to us by the holding company's management. This is very important. From where we got the report. If we are not audited, we specify that we have not audited. They have been audited by other auditors, but the reports were furnished by the holding company's management. And our opinion insofar on these consolidated financial statement related to these disclosures in the subsidiaries, associate, joint venture, okay, including report on the other information, okay, is based on the reports of other auditors. That means we are placing a reliance, okay, on the information or the audit report which is performed by the which is performed by the other auditors. So first of all, we identified this, the components. Then we say this has been audited by other auditors and report was given by management. And then we place a reliance, okay, that okay, we have relied upon the reports and accordingly we have formed our opinion. See, something more to discuss, something more is given on this scenario. We did not audit the financial statement of 15 subsidiaries whose total information reflect total asset, total revenue, comprehensive everything as on date of the consolidated financial statement, group share for the two associate and joint venture, and then financial statement has not been audited by us. Okay, so these financial statement information and joint ventures are unaudited and have been furnished by us by the holding company's management. Again, very important part. We are now bringing attention to the unaudited information which is furnished by the management to the us. Okay, which is furnished by management to us. That means there is something unaudited in the consolidated financial statement. Now, which has a net asset of this much amount. Again, we are specifying 15 subsidiaries with net asset, total revenue, total comprehensive income, net cash flow. For the two associates and joint ventures, we are specifying the group shares of total comprehensive income. And we say that this is something not audited at all. And we have relied, and our the opinion of the auditor, of the principal auditor, okay, is based solely. So our opinion, that is the principal auditor's opinion, is based solely on such unaudited financial statement and information. Okay, and we are also saying that they are not material to the group. Not material to the group. Remember, in the materiality, we were talking about we need to identify what is material, what is not material from the components perspective. If something is not material, we can exclude. If it is unaudited, we can rely. So similarly over here, see, based on solely on such unaudited financial statement and financial information, our opinion, the opinion of principal auditor, is based on unaudited financial statement. Why? Because it is not material to the group, and accordingly, fine. So you need what we have done in this scenario. We have identified the components. Okay, their FS elements. We have said they are unaudited. We have said they are not material, and we have relied FS provided by management. If it was material, then let's say, for example, let's say if there was a material component which was unaudited, you will ask them to audit. You will ask them, okay, provide us the audited financial statement. If there is no audited financial statement, then you might perform additional procedures, or you might ask them, that we will audit and you will take up a separate engagement if permissible. Even if that is also not permissible, then the only option remains is you need to evaluate the impact of the unaudited portion on your opinion. Whether the unaudited portion, and whether your failure or your inability, kind of thing, you can say, to form a opinion because of the management limitation on that particular unaudited component portion, is material and pervasive, or the possible effects of the unaudited financial statement and the misstatement present in that is material and pervasive. If yes, you will issue a disclaimer. Otherwise, you may issue a modified opinion, a qualified opinion. So this is very important part that we need to understand, is that from the perspective of the consolidated financial statement, audit of a consolidated financial statement, we have to report something under SA 600. Okay, and accordingly we need to provide this disclosure. Rather, there are some practical scenarios in past. I have seen there was an unaudited portion which was material, and on the basis of that it was qualified, but very rare, because most of the listed company would not like to have material qualification on their audit report. They will, of the subsidiary gets the accounts audited if they are the some very rare scenarios that is possible. That has happened also, I think. Okay, one very important. Any doubt till now with respect to this disclosure that we have seen in the audit report, annual report? Yes, no? Any doubt till now? Okay, if no doubts, what I will suggest is, let's take a quick 10-minute break. After the break, we will go and we will see what SA 600 says with respect to this disclosure, and we will discuss some more complex scenarios where we are the auditors, where if what is required to be done in that particular scenario. Okay, so we will take up some more scenario, and we will see how to report on that. So let's take a quick 10-minute break. Shall we start? Shall we continue? Hello, everyone. Welcome back. Let's continue the session. So we were discussing about the other matter paragraph reporting and additional reporting which is done. Okay. So what we were discussing that how the reporting in other matter paragraph is done. Now I will show you some more report. Okay. A particular one more report wherein we will see something different now. One more additional disclosure kind of, you would say, that which is there in that particular audit report, okay, or in that particular annual report, and it's part of the annual report. So again, I would request not to focus on the name of company because publicly available data, it's just for your understanding. Okay. So in this particular annual report, or in this particular audit report, again we have this other matter paragraph. This other matter paragraph, again for your understanding purpose, on the similar lines, that we did not audit 35 joint operations. Okay. Again, whose total assets, whose total revenue, net cash flow have been included in the consolidated financial statement, were audited by other auditors. Fine. We did not audit 74 subsidiaries having total revenue, total assets, net profit, net cash flow, have been audited by other auditors whose report has been furnished to them. Okay. Whose report has been furnished to them, and it has been like based on the reports of other auditors. So if you see here, there are 35 joint operations, 74 subsidiaries, 2 associates, 7 joint ventures. Okay. Basically, these are, if you see, again, audited by other auditors whose share has been net share of the, other comprehensive income included in the consolidated financial statement. Then 15 subsidiaries, okay, plus 3 associates, 2 joint ventures, not been audited by us. Unaudited, report furnished by the management, and they are not material to the group that has been realized. Similar line, what we have seen till now. One more report, one more particular part that which is there. Our opinion on the consolidated financial statement and our report on the other legal regulatory below is not modified in respect of the above matters, respect to our reliance on the work done, and the report of other auditors and financial information certified by the management. That means there is no modification based on the other auditors report. Plus, the consolidated audited financial statement for the year ended 31st March 25 included in the accompanying consolidated financial statement were audited jointly with the president auditor, joint auditor, for which the report dated May 8, 2025 expressed an unmodified opinion on those consolidated financial statements. A very interesting kind of reporting paragraph. There is a previous auditor, okay, who has audited with this auditor the consolidated financial statement. So joint audit of CFS plus there was a different joint auditor, different predecessor auditor who was also joint auditor, predecessor joint auditor. For that, there is a disclosure. For that, there is a disclosure. Okay. Very important part that I just wanted to highlight one very good, uh, part over here. The reason this is being highlighted is, see how it can also be related to the consolidated financial statement. So most of the people think that okay, we have only predecessor auditor in the standalone financial statement, but it is not correct. It can be there in the consolidated financial statement, and the reporting can get triggered in for the purpose of consolidated financial statement. Okay, so very important part. And now let us go to the SA 600. Now SA 600 provides certain reporting considerations. Okay, reporting considerations. Now, what are these reporting considerations? Basically, when I talk about reporting on the consolidated financial statement, first of all, you need to understand that is there any qualification on the audit reports of the components that you have received. So, principal auditor should conclude, okay, that whether he can form an opinion based on the audit reports that he has received, or is there any qualification. If there is a qualification in the components auditor report, then how he has dealt with that qualification, like which is there in the components auditor's report. So accordingly, basically the principal auditor is required to, okay, is required to, take care the opinion on the consolidated financial statement. See, what happens is, if let's say, for example, there is a qualification in the component which might not be relevant, and I have a very good example to demonstrate that. Amazing example. Again, this particular audit report is available publicly. Okay. Again, not to point out any company. Please do not focus on the name of the company. It is for your understanding purpose. We'll go to the CFS. This is the independent auditor's report. Okay. This is on the consolidated financial statements. But this time we have something called qualified opinion. We have a qualified opinion. Now, if you go to the basis of qualified opinion, you will see that there is something with respect to the subsidiaries or the component that we draw attention to the note 25 of the CFS, wherein the auditors of a particular subsidiary has pointed out some issues, that there was a loss, a lot of things are there. So there is something which is pointed out by the subsidiaries auditor, and because of that, the principal auditor says that okay, because of this I feel there should be a qualified opinion on the CFS. So the subsidiary auditor has a doubt on the going concern. So there were conditions and events indicated that the existence of a material uncertainty that may cause significant doubt about that subsidiary, so ability to continue as a going concern. Okay. Now, even however, the financial statement of the subsidiaries were prepared on a going concern basis. In the absence of the necessary evidence with respect to the management assessment of going concern, they were not able to get the adequate evidence regarding the management use of going concern assumption. And as a result, there is a qualification in the subsidiary, because of which there is a qualification in the consolidated financial statements audit report. Similar, another one. Okay, there is another financial statement of a subsidiary, again net worth, again same thing. There is a bankruptcy going on, significant doubts about the entity's ability to continue the going concern. A lot of things are there. Third entity, okay, again same part. So there are multiple things. Then again, auditors of fourth entity, okay, has pointed out some issue with respect to the credit loss and recoverability assessment that was not performed by the management of that entity as per India's 109. Okay. As a result, they were not able to comment on the adjustment required in the carrying values. And because of all these things, there is a qualified opinion in the consolidated financial statement. So what you have seen is qualification in component may impact your CFS audit report opinion. That is what SA 600 says. Okay, so if you go and see SA 600, SA 600 says same thing, that when principal auditor concludes based on his procedure that the work of another auditor cannot be used, or not being able to perform sufficient audit procedures, he shall express a qualified opinion. Means if there is something which is because of which he is not able to give the appropriate opinion on the consolidated financial statement, he should issue a qualified opinion. That is what is happening, that he is not able to use the work of another auditor because they are even also not able to get anything. Okay, so work of another auditor cannot be used, not been able to perform sufficient audit procedures because it's a component. Okay, because the financial information of the component audited by other auditor. Okay, and because of this limitation on the scope of audit, he should either express a qualified opinion or disclaimer opinion. That is what is happening in this particular scenario. The principal auditor has to evaluate what are the findings which are reported by the other auditor. Okay, he has to evaluate and how they are impacting the consolidated financial statement. So if he thinks that the findings or the qualifications of the component auditor are material from the perspective of the consolidated financial statement based on the materiality provided, qualify. If the effective, material and pervasive, issue adverse opinion. If they think that yes, the qualification which is provided by the component is not a material and not qualify that, I may not qualify that. So accordingly, the qualification, the significant finding of the component auditors are required to be considered by the principal auditor. Auditor has to document in his working paper, okay, that what were the conclusions reached. So the principal auditor, this is very important and this is required. The principal auditor should document in his working papers, okay, that components whose financial information were audited by other auditors, their significance to the financial information of the entity as a whole or a group as a whole, okay, name of the other auditors, conclusion reached at the individual component that are not material, procedures performed by the principal auditor for the conclusions that has been reached. Okay, so principal auditor has to document all these things, that if there was something in modified opinion in a components auditor audit report, how I have dealt with that, how I have whether it is whether that particular part is material for me as a whole or not. So the principal auditor should also document how he has dealt with the qualification and adverse remark contained in other auditor's report in framing while framing his own report. So that is not only required to go in your audit report, but it is also required to go in your document and working papers. So here, whatever we have seen in the audit report. But not only the audit report, the auditor is also required to document all these things in the working papers. Let us see the standalone financial statement for a while. Okay, now see here, very amazing thing that we can see, the standalone financial opinion is unmodified. There is no modification on the standalone financial opinion, but you have a modification on the consolidated financial opinion. Yeah, you may have a material uncertainty relating to going concern para in the standalone. And again, not only this particular paragraph, we will go to the consolidated again. So if there is something which is reported in the component auditor's financial statement, like emphasis of matter paragraph, that is also required to be considered here. Okay. So here, if you see, there are other entities involved, component, like X entity, Y entity, there is some, fraud case going on. A lot of things are going on, for which there is a notice from ED, Money Laundering Act. A lot of things are going on. Okay. And that is being highlighted by the auditor of the CFS. May not be there in this, standalone financial statement. It is there in one of the components financial statement, and from there it is coming to the CFS. Okay. Again, material uncertainty relating to the going concern. So not only the holding company has highlighted that, but there are other entities where this has been highlighted. So which is part of the basis of qualified opinion we have already seen. So not only from the holding company's perspective, but there is, as a group, they have evaluated whether the group is able to meet its obligation or not. Till now, you were seeing going concern only from the entity's perspective. But here, we are seeing application of SA 570 from the group perspective, from the CFS perspective. And accordingly, that has been provided over here. Very important part. And again, like other matter paragraph will also be here present. Yeah, other matter paragraph. Simple. We did not audit. Okay, that has been audited by other auditors, and the auditor has relied on the audit reports. Okay, there might not be any entity which is not being audited, and accordingly that is fine. Okay, so that is something SA 600 says that when you are basically preparing the audit report of the consolidated financial statement, or when you are relying upon the work of another auditor, so while preparing or while reporting and using the work of another auditor, consider these scenarios. Plus additional responsibility of reporting, that principal auditor has to base his opinion on the financial statement of entity as a whole by relying upon the statement and reports of other auditors. He should clearly state the division of responsibility, extent to which the financial components and financial information of the components have been audited by other auditors, like number of division, branch, subsidiary, or other components audited by other auditors. This is nothing but other matter paragraph we are seeing. Division of the responsibility, that is there in your SA 600. Clear? Any doubt till now? So come to the page number 13.25 of your study material. We will see certain scenarios, reporting scenarios. Scenario number 1, when the parent auditor is the auditor of all its component. When the parent auditor is the auditor of all its component. Tell me, in this particular scenario, are you required to provide other matter paragraph? Are you required to provide other matter paragraph? Very good, Kanaya. Yes, no. Are you required to provide other matter paragraph? Very important question. When the auditor of all the entities is same, including the component. Including the component, if all the auditor for all the entities is same, in that case, what is required to be done? Are you required to provide the other matter paragraph that we have seen? Absolutely correct, Radha. See, if when the parent auditor and the auditor of all other component is same, why you will apply SA 600? SA 600 might not be applicable because there is no other auditor. So there is no other auditor. You are the only auditor. Your work you will use. There is no need for other matter paragraph reporting. When the parent auditor is not the auditor of its component, at that point in time, other matter paragraph will come. Okay. At that point in time, you need to consider SA 600 and other matter paragraph. So yes, at this particular point in time, other matter paragraph will come. Then, when the components audit report on the financial statement under an accounting framework different than the parent, that means when the component is, let's say, outside India, reporting framework, accounting framework, let's say Singapore, there is a Singapore FRS which is being followed by them, different than the parent. What you will do? What you will do? How will you report? Not only other matter paragraph, but what you will do in that particular scenario? How will you report? Anyone? Absolutely correct. Accommodating the material transaction, I need to basically harmonize. I need to pass, I need to audit those adjustments, and then I need to bring to the uniform accounting policies. Yes, along with that, other matter paragraph will be there. So harmonization plus other matter paragraph. We already seen. Okay. So when component auditor report on financial statement under a accounting framework different, then conversion do for the conversion from the US GAAP or IFRS to the local GAAP. Okay, you need to perform this conversion, harmonization. You need to follow the uniform accounting policies. Okay, parents accounting policies, and accordingly you need to see what is the the parent company's accounting policy will be a group accounting policy to follow. Then the next case is when the component auditors report under an accounting under an audit framework different than the parent. That means the auditor is also using some different set of standards than the standards being followed by the parent auditor. What you will do? What you will do? Other matter paragraph will come. Yes, other matter paragraph will come. I totally agree. But apart from that, what you will do? Apart from other matter, what you will do? Simple. You need to coordinate. You need to let the other component auditor know how his work will be used, what he is required to do, and provide the information about the auditing framework that is being followed by the principal auditor. So you need to follow SA 600, whatever we have discussed. Follow SA 600, nothing else. You let them know that this is the auditing framework under which they are required to audit. These are the additional things they are required to do. Make sure you explain them that how their work and their report will be used by the principal auditor. Okay. Now the last component not audited. Component not audited. Very good, Radha. So component not audited, there are two things. One, check whether material or not. Okay. Whether material or not. Then you go for other matter. If not material, then only go for other matter. Otherwise, go for the qualification. Or perform additional work, or if you are not able to gather additional audit evidence, you are not able to perform the work, not able to do anything, go for the qualification. Okay. Check for whether material or not. If not, then only other matter paragraph. Simple. Don't directly jump to the other matter paragraph. No. If it is material, then either you need to perform additional work, or you need to perform, you need to ask the management to get it audited. And if nothing is possible, then qualify. So you have options over there. Additional procedure, audit, and the last option, modified opinion. Okay. If these two are not possible, then only go for modified opinion. Otherwise, don't go for a modified opinion. Simple, straightforward, that we have understood after the example that we have already seen. Any doubt? Any doubt? But one doubt I have, I did not discuss this part. Joint audit and the predecessor auditor. I did not discuss this. From where it is coming? Anyone? Where it is written? I did not discuss this. So this particular part is coming from anyone? Which essay? Essay 710. Over there is a requirement, prior period financial statement audited by a predecessor auditor. What is the responsibility in case when the prior period financial statements are audited by a predecessor auditor, and you are providing that particular financial statement in the as a corresponding figures. So you learn what is corresponding figures, what are the comparative financial statements under SA 710. This is coming from there. So SA 710 plus something related to the CFS we are applying over here, and accordingly, this is being coming into the picture. Why 501? (501) talks about specific audit evidence in certain cases only. Like there are three things: existence and conditions of the inventory, then you have a litigation and segment reporting. Initial opening balance. Okay. Initial balance. Okay. See that basically, over there also this SA 710 will be triggered, because if it's an initial audit engagement, that means there was a predecessor auditor in the picture. Okay. So 510 and 710 will go hand on hand. So it will not happen that you have an initial audit engagement but there was no predecessor auditor. Very rare scenario. Yes, that is possible, that there was no predecessor auditor, and this is the first time you are getting audited, and there is an initial audit engagement. Again, for that also, you have SA 710, because it says that if period financial statements were not audited, that is also required to be reported in other matter paragraph. So you need to comply with 510, but the reporting goes as per the 710. Any doubt till now? If no, then there was one question that we were discussing. Let's go back to that particular question, because that was there. One part of that question was pending. Now I think you will be able to answer this question. Explain how the principal auditor will document the working paper with respect to the subsidiaries audited by the other auditor. What matters needs to be documented in the other auditor's report if modified. Now tell me what principal auditor is required to document when he will prepare the documents for the work performed by another auditor. We have just now seen this particular part. Very good, Radha. Yes. Straightforward answer we discussed some just few minutes ago. Straightforward answer. Anyone? Straightforward answer. So what we discussed was this: the principal auditor shall document in his working paper, first of all, the components whose information was audited by other auditors, then their significance as a whole entity, as a whole, okay, to the financial information as an entity or the whole, name of those other auditors, okay, then conclusion, any conclusion reached by that individual component that are not a material, because that is also you need to document. You are any which ways going to consider the material ones, but you need to document the conclusions reached that the individual components are not material. You need to document that why they are not material. Then you need to document the principal auditor, the procedure and conclusion reached. Okay, the procedure and performed and the conclusion reached on all this information that you have gathered. And at last, very important, document that dealt with the qualification or the adverse remark contained in the other auditor's report in while framing his own report. No, it will not be. So there is one question. If we go on documenting the non-material for individual component will be very cumbersome. No, see, what you are documenting for the non-material, the reason why it is not material. Okay. So if you like the conclusion, you need to document conclusion why it is not a material. Like by comparing the numbers, by showing why it is not a material. You need to document that conclusion. I cannot just say, okay, it is not material without documenting the reason why I say it is not material. Okay. So what are the points that the auditor should document? One, the component audited by others. Second, their significance, because these are material. Third, the names. Fourth, Non-material, fifth, your procedures performed by principal auditor. Sixth, dealing with the qualification. 6 items that we have seen now. Clear? Any doubt on this? Any doubt? Most of the students, when they will see this question, they will see this particular line. How he will document the working papers. They will go to the risk assessment, they will go to the fraud risk, they will go to the materiality, all those things. Most of the students, when they will read this question, instead of, like in exam, what happens is, if you do not read the question appropriately, okay, if the question, you may get a different meaning. You may, not get the appropriate meaning of the question, what is being asked. And in that sense, you will write entirely a wrong answer instead of, a simple answer that you might be aware, but because you did not understand the question appropriately, you will lose the entire marks. And that's where the problem arises, because most of the time when we are writing the answer in the paper, we are in so much hurry, we are in so much pressure that we forgot and we do not focus on the question what is being asked. People will see how he will document the working paper. They will focus, okay, documentation. So they will go to essay 230. They will provide the reference of essay, that particular essay. Okay, how this documentation happens, what standard is there. Okay, a lot of people will go in detail, like permanent file, yearly file, a lot of things they will go on that particular time. Timely documentation, no. Assembly of the audit file. Some students may also go to the quality control. That is not required to be done. Actually, it is not required. If you quote essay 230, but any which way, see what is essay 230? Essay 230 says how you need to document. Okay. But here we are talking about how he will document the working paper with respect to the subsidiaries and what matters. So we need to provide more on the matters rather than the essay 230 part. Okay. So here you need to specify the matters rather than the going to the essay 230, and that is how you are required to write the answer. Any question? Any doubt? All clear? Any doubt? So that was your chapter number 13. We have discussed this reporting pass also, and we have solved some questions, and then you have a good amount of questions given in test your knowledge. Please practice these. Please practice, because we have already discussed from the practical perspective, and whatever we have discussed now requires your reading, because we have discussed everything in detail with the practical examples. Now you need to go to and read the chapters so that you can get more clarity, and then solve these questions. Please, that is very important. Solving these questions is at most important. Clear? Any doubt? That is your chapter number 13, group audit. Okay. Again, if anyone wants to join the session, please log into the BOS portal, go to the LVC May 27. You will get an option to join Zoom. Click on that and join the session. Okay. You can now join the session from the start itself. So if anyone is watching through YouTube, please join the session. Okay. See, the question that can come not in this particular chapter, but in the other chapters also, it may be, combination of the knowledge that you have learned in other subject also. So for example, group audit, yes, there is a knowledge of financial reporting which is being applicable over here, but there could be other areas, there could be other, chapters, there are other chapters where the knowledge of some other particular subject might come into the picture. So at that point in time, you need to understand that not only when you are answering the question on the audit, you don't only need the understanding of the audit concepts, you also need the understanding of the financial reporting framework, applicable laws and regulations. For example, tax laws. If there is something with respect to the tax laws and there's a question on, let's say, SA 250, so SA 250 tax laws, that will require not only the understanding of SA 250 but also the some bit understanding, basic understanding of the income tax laws. So that is something you need to be mindful of, that a question may not be only on the audit, it will test the application of the knowledge that you have on the auditing concepts. Any doubt? Okay, if no doubt, then let's proceed and let me start the next chapter, which is chapter number 14. See, for the chapter number 14, chapter number 14 is divided in two units. Unit 1, which is the audit of bank, and Unit 2, which is the audit of NBFCs. Okay, we will first start with the Unit 2, audit of NBFCs. And why? Because amendments over there, good amount of amendments, I will say, in the audit of NBFCs. Again, part of the same section, section number 3, where chapter 13 to 17 carries 17 to 24 marks. Okay, so chapter number 14, Unit 2, we will start now. And why why NBFC is very important? As I said, there are amendments to that particular chapter. We need to understand that, and accordingly, we need to proceed ahead for the chapter. Okay. So let me bring up the study material. Okay. So this is unit number 2 of chapter number 14, which starts from the page number 14.83. Okay. Now, when I talk about NBFC, and the audit of NBFC, see, NBFC is a very regulated entity. NBFC is one of the regulated entities. Okay, we call them the RE. Okay, NBFC is a regulated entity. And can anyone tell me who regulates the NBFC and its working and its operation? Who regulates the NBFC? Who regulates the working operation of the NBFC? Can anyone tell me that? RBI, very good, Radha. Yes, RBI is the particular body regulator who regulates the working of NBFC. Okay. If I say that way, that would be partially correct. That would be partially correct. It is not 100% correct. Because when I talk about term NBFC, non-banking financial company, this contains a very different type of NBFCs. So first of all, let's understand what is an NBFC. Then we will go and understand, we will deep dive into the regulated entity concept and regulations. because when you will audit the NBFC, you need to understand their regulations. Similarly, when you audit a bank, you need to understand what is the regulations that are applicable to them and what is the applicable financial reporting framework. But as of now, first of all, let's discuss who are NBFCs. Simple. Can anyone tell me what is the definition of an NBFC? Come on, anyone? What do you mean by the term NBFC? What is the definition of NBFC? NBFC is a non-banking financial company that offers financial service loans, but not a traditional bank. Fine. Companies engage in lending and borrowing. Yes, fine. What else? Come on, quickly. What do what comes in your mind when we talk about NBFC? Which is not a bank? Yes. Okay, which is not a bank. Absolutely correct. So when we think of an NBFC, we basically think that a company, NBFC is a company only, non-banking financial company. But this company is into the business of financial companies. Okay, so it is a non-banking. It's in the business of non-banking finance companies or non-banking financial institution, which is not a bank, but something similar performed like a bank. Yes or no? So we are talking about an entity which is performing something similar like a bank, but it is not a bank. Okay. Now, can anyone tell me where the definition of NBFC is mentioned? Like, if you have to identify NBFC from its operations or from its working, there might be some definition somewhere in the law, because it's a regulated entity, without which you cannot have appropriate classifications. So where you can find the definition? Anyone? Where you can find the definition of NBFC? Section 45I(f) of the RBI Act. Very good, Radha. Yes, RBI Act. So we need to now go to the RBI Act, Reserve Bank of India Act 1934, to understand what is an NBFC. From there, we will get our understanding of the NBFC. Okay. There is a chapter under the RBI Act, a chapter which basically governs the provisions with respect to the NBFC. That is known as the Chapter 3B. Basically, it's a Chapter 3B. Okay. So if you see, there is a Chapter 3B which governs the provisions relating to a non-banking institution receiving deposits and financial institutions. So it covers from section 45H, which includes 45H, IA, IB, and all other sections, to 45QB, because a lot of things are there in that. But for our relevance, there are two to three sections that are more important. First, section 45I, which is definitions. 45IA, requirement of registration in net owned funds. 45IB, maintenance of percentage of assets. 45IC, reserve bonds. Okay. And then the rest of the things that we will see, but not major. Okay. But as of now, 4 important sections of the RBI Act: I, IA, IB, IC. Okay. So NBFC, 45IA, IB, IC, IB, IC. Important sections. Now let us go to the definition 45I, which is there specifically for the purpose of Chapter 3B. Okay. Now, this particular part will be very important. You have to pay attention to this. Then only you will be able to understand how things are working. Okay. So please make sure you pay attention to whatever now I'm discussing with respect to the definition part. So there is section 45I definitions. Okay, 45I definitions. Now, here, in order to understand, first of all, see what it says that 45I says that this chapter is not applicable to State Bank or any bank under Banking Regulation Act, which is into the similar business. So it excludes the basically banks from it. So it is only applicable to NBFC. Now 45I has multiple definitions. And first definition that we need to understand, under section 45 is 45I subsection F. Okay. 45I subsection F, which is non-banking financial company, NBFC. So NBFC, primary definition of NBFC is in 45 subsection F. What is the NBFC? What is the definition says? NBFC means a financial institution, which is a company. That means no LLP or other form of entities. Okay. But any which ways, as of now, we will not discuss go on that particular track. So what is the first part is financial institutions. A non-banking institution, which is a company, and very important, which has a principal business of receiving deposits under any scheme or arrangement or any other manner, or lending in any other manner. So this particular point says that either it should, first point says it should be FI. Second point says it should be NBI, plus it should have a principal business of receiving deposits or lending in any manner. So principal business of receiving and lending. Okay. Third says such other NBI or classes of institution notified by central government. So if central government is of the opinion that there is something which we want to classify as an NBFC, we will classify. Now, we need to understand what is a financial institution and what is a non-banking institution. Simple. We'll go to the non-banking first. If I talk about non-banking institution, it is defined just here. 45I subsection E. Non-banking institution, NBI. Okay, so NBI is coming from here. I'll provide a reference to the NBI from here. Okay, so NBI is coming from here. Now, what NBI, sorry, not this one. It should be this one. This one, yeah. So what NBI is, NBI means a company, a corporation, or a cooperative society. Non-banking institution means a company, corporation, or a cooperative society. That's it. Company, corporation, or a cooperative society. Fine. Simple. That's a non-banking institution. But if you see the definition, this second number point, it says that not only non-banking institution, but it has to have a principal business of receiving deposits and lending in any manner. So not only the NBI, but NBI plus principal business has to be satisfied to become the NBFC. So NBI is just a classification that it can be a company, corporation, or society. And if you include the principal business, it will become the NBFC. Okay. Now, what is a financial institution? Financial institution is defined in section 45I, subsection C. That's the financial institution. Over there, it is defined. So I will make a reference over here. This is 45I, subsection F, sorry, E. And this is 45I, subsection C, the definition of financial institution. If you see, financial institution means any non-banking institution, again, which is there in the E, carries business or part of business of the following activities. Means NBI plus business. NBI plus business specified below. And what is the business? Business of financing, making loans or advances, okay, acquisition of shares, stock, bonds, debentures, letting or delivering goods on a hire or hire purchase mode, okay, carrying on any class of insurance, managing, conducting, supervising foreman, agent, or whatever it is, okay, other things, or collecting monies in lump sum or otherwise, okay, by subscription or sale of units, and awarding prizes, all those things, everything. But does not include, has a principal business of agriculture, industrial, kind of, providing that, okay, it is something into
Maybe some technical issue is there, so he got disconnected. Must be joining now. In the meantime, dear students, if you have any query, you can ask me. Radha, you were supposed to call me and discuss the questions. Yeah, Kanaya, tell me.
box. If you can just ask.
Yeah.
If I'm audible, just let me know in the chat box. And if you can see the screen, just let me know.
Sir, you are audible.
Okay, great. Okay. Sorry for some technical, internet issue in between. So what we were discussing about the definition of financial institution. Okay. We were discussing that, like, what is a financial institution? We were discussing that the definition part. Kameshwari, you can ask your question in the chat box. I think there is some issue. I will not be unmute you because there is some. Try if you can see, and if you can, you can write in the chat box. Okay. So when I was discussing this financial institution, everywhere we are talking about giving loans. Everywhere we are talking about acquisition of shares. Nowhere we are talking about deposits. So specified business only restricted to the financing and shares. Okay, but nowhere we are talking about accepting deposits. So if there is an accepting deposit, that has to go under this particular definition: principal business of receiving deposit and lending in any manner. Okay, now we need to understand something very important over here. We need to understand one more part over here before we fully understand a non-banking financial company. See, there is a registration requirement under 45 IA. But that registration requirement not only is applicable to a non-banking financial company. Let's read 45 IA for a time being. What 45 IA says? 45 IA says a non-banking financial company shall not, okay, a non-banking financial company, no banking, no NBFC shall commence or carry the business of NBFI. This is important. Business of NBFI. Okay. Non-banking financial company does not in itself will, need a requirement of registration. But if you are an NBFC, that means if you fall under any of the definition, you should not commence your business without obtaining a certificate of registration. For that, we need to understand what is the business of non-banking financial institution. And that's where 45I subsection A comes into the picture. A business of a NBFI. That is, if you do anything which is there either in clause C or F. C is a financial institution and NBFC in F, you are doing a business of NBFI. So that means in nutshell that if you are into a lending, if you are into the receiving deposit, if you are into the financing, if you are into the acquisition of shares, if you are into the class of any insurance business, you are an NBFC. You need to obtain a certificate of registration before you start your operations. Okay. Now, one question I have, sir, a multi-state cooperative society is an NBI? Yes, absolutely. So multi-state cooperative society can also be NBI, and if they are into the principal business of receiving and lending in any manner, it will be an NBFC. Why it will not be a financial institution? Because it's not a company. Okay. The first condition is FI plus company. FI plus company. So multi-state cooperative society will not fall under the category of FI plus company. Definitely it will go under the NBI plus principal business. Now another question comes. Sir, what is principal business? How will you define the principal business? See, when I talk about FI, when I talk about company, over there it says business or part of business. If you see the terminology which is used, it says business or part of business. Not necessarily the entire business. If any part of the business is any of the following activity, you are an NBFC, business or part of business. If you do any of the following activity, then you are financial institution. Okay. Now, coming to the part when we talk about, if we go to this route, second number, over there it is not saying business or part of business, but the term which is used is principal business. And that's where we need to understand what is So we need to understand what is principal business. Let's say a multi-state cooperative society which is into the receiving deposit and lending in any manner. Just because they are into the receiving deposit and lending in any manner, will I qualify them as an NBI? And will I qualify them as an NBFC? Because NBI can mean company, corporation, or cooperative society. Let's say a hypothetical example, A Private Limited. Okay. Receiving deposits. Is this a NBFC? You will say, sir, private limited company, financial institution. Yes, but where it is there? Like, if you see the financial institution definition, it is financing, making loans or advances, not deposits. Acquisition of shares, carrying on any class of business. But where? Like, we are talking about receiving deposits in this NBI. So, how it will be? How will you then, call that A Private Limited as a NBFC? Anyone? I need to understand the principal business. And even you have a definition of deposit. What is deposit? That's why they have defined what is deposit. And the definition is very wider, that any money, any receipt of money by way of a deposit or a loan in any other form, but they have provided the negative list, like share capital, capital by partners, amount received from scheduled bank, amount received from state financial corporation, or other such things, or amount received in the ordinary course of business like security deposit, dealer deposit, earnest money, advance other against orders, all these things. So that is, they have defined what will not be a deposit, but apart from that, everything is a deposit. So for this particular purpose, I need to understand one more question is whether receiving deposit is its principal business. If yes, then only I will classify this as a NBFC. Because if you see, even in the financial institution, there is something similar mentioned, that if the financial institution having principal business of agricultural operation, industrial activity, okay, then here purchase and sale of any goods, purchase and construction of immovable property, then I will not classify that as a financial institution, but does not include any institution which carries on this thing. So for that, I need to understand what is principal business. And from here, there is something called principal business criteria that we will understand. Okay. Principal business criteria. Now, to understand the principal business criteria, we will take a reference of a regulation. We will take a reference for timing. I will introduce a regulation so that we can, as of now, understand what is principal business criteria. Okay. So we will go to a regulation and we will discuss some principal business criteria over there. Just a minute. Let me bring the regulation. As of now, I'm not discussing the name of regulation. We will come on that But let's understand something on the principal business. Okay. There is a lot deeper that we need to go, but as of now, we will understand something with that. Oh, okay. Yeah. Principal business criteria. Okay. Principal business criteria. Now, what this regulation says, any company which carries on the business of NBI as its principal business defined in 145 IC, read with 45 IF, shall be treated as an NBFC. IC, what is IC? What is IC? IC was financial institution. Because over there we are talking about that if its principal business is not an agricultural operation, industrial activity, purchase of sale, purchase of construction, that means it has a principal business of financing, acquisition of shares and everything. And 45 IF, principal business of receiving deposit and lending in any manner. If you have a principal business of this, which is provided in 45 IC and IF, you would require registration under 45 IA. We understood that. Now, the term principal business is not defined in the RBI yet. But there is a press release of very old, 1999, which has defined the term principal business. And over there is a classification or there is a criteria that if a company, okay, has a financial assets which are more than the 50% of its total assets netted off by the intangible, and the income from such financial asset more than 50% of its gross income, both requirements are to be satisfied. Both these tests are to be satisfied. Then only I will treat that NBFC as that particular company as a NBFC. So this is 50-50 criteria, principal business criteria. What is 50-50 criteria? That 50% or more of your total assets shall be your financial assets. And 50% or more of your gross income is the income from that financial assets. Okay, again, 50% or more of total asset, okay, shall be your financial asset. That means financial assets, sorry, let me bring this side. That means your financial assets shall be more than 50% of your total asset. Second, your income from that financial asset, income from FA, not fixed asset, it's a financial asset, okay, shall be more than, okay, 50% of your gross income. One more thing, one clarification that I've done a mistake over here is not equal to. I need to remove this. It has to be more than, not equal to. So the term is more than 50%. That means 51% or more. If it is 50%, no. It has to be more than 51%. Okay. So more than 50% of your gross income shall be the income from these financial assets. And that has to be satisfied both the tests. This also. If you satisfy both the tests, then only a company can be treated as an NBFC. That's the principal business criteria. Clear? That's the principal business criteria, and that is coming from a circular, a press release dated 8th April 1999. Any doubt till now? to the introduction of what is NBFC. So we have understood what is NBFC. So if you have to answer the NBFC, it is 50-50 criteria, which is given under 45I C and 45I F of the RBI Act, and it can be company and everything. Clear? Now, some may ask, sir, for FI, do we need to check 50-50 criteria? Yes, you need to check. Otherwise, how will you prove that the principal business is not an agricultural operation, industrial activity, purchase and sale of any goods, or purchase and sale of construction of immobile property? If you'll establish that the principal business is of lending and receiving deposits, that means the principal business is not of agricultural operation, industrial activity, and purchase and everything, which is given. So you need to test for even financial institutions in indirect way to demonstrate that they are not into other activities. Any doubt till now? Any doubt? You can write your questions in the chat box. No doubt? FI means yes, NBI. Okay. FI means an NBI. Any NBI. Again, but if you see the definition of NBFC, it says FI, which is a company. So even though if I say NBI, I have to restrict to a company. Like, it's a bit of redundancy over there, but yeah, it's there. So to qualify, you can be any NBI. But for the NBFC, you have to again, go back to the company for the purpose of FI. So it's kind of a, you can say, a bit of redundancy that has to be rectified. But again, the crux will remain the same. Any doubt? Okay, if no doubt, then what I propose over here is that please read chapter number 14, unit 2. Read that. That is very important. And for the chapter number 13, complete your reading. Complete the practice. Okay. Complete other questions which are either given in the RTP, MTP, and everywhere. And then bring your doubts from the chapter number 13 in the next session. So you have 2 chapters to read. Chapter number 14, unit 2. Chapter number 13, if you are not read. Okay. And you have to practice chapter number 13's question to get better understanding and to bring the queries in the next session. If you have to understand the subject, if you have to score very good, please follow these things. Okay. And in the next session also, again, just announcement that you can directly log in into the session. That means by logging into the BOS portal, by going to the LVC May 27 option over there, you will get join Zoom option. So go to the BOS portal, log in with your credentials, go for the LVC May 27. Over there, you will get a join Zoom below. Okay, a blue button, join Zoom. Once you will click that, through that, you will be able to join this particular session from start, and you can ask your doubts. Hi, sir. Good evening. Portal is crashing. 404 error. Uh, might be some technical glitch for a time being, but there is nothing much because I have I have opened it right now. It is working perfectly fine. So might be some internet issue at your end. Could be possible. But as of now, it is working fine. There is no issue in that. Okay. If no further doubts and no further questions, then thank you guys. Thank you for participating in today's session. Uh, let's meet in the next session. Thank you. Oh, okay. There is one doubt. Yes, Radha. There is one doubt. Yes, Radha, you can ask. Sir, in FI definition, the financial activity other than making loans and advances, okay, in financial institution definition, financing other by way of making loans and advances or otherwise of any activity other than its own. No, making loans and advances, but NBFC prima facie is loans and advances, right? No, 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 no. NBFC is both receiving deposits and making loans and advances, both. And there are credit ratings regulations for the NBFC for the deposit they accept. There are multiple things involved in that. So just to give you a glimpse of that. If there was no need for the deposit, then there was no need for the definition also. But there are multiple type of NBFCs. Okay. Let's say NBFC financial company acceptance of deposit direction 2025. Okay, there are directions for that peer-to-peer lending. So if there is a lending for one NBFC, then there will be acceptance for another NBFC. Again, acceptance of public deposit directions. A lot of things are there in that. So I would not say it is only about lending. It is both. Hi, sir. Insurance brokerage firm comes under the NBFC. See, there are different kind of NBFCs. Yes. Okay. Insurance brokerage firm, but prima facie there is an exemption given. Okay. Under the NBFC regulations, who are required to register and who are not required to get registered. So if you are into the carrying on any class of insurance business, yes, you will be classified as an NBFC. But are you required to take registration with the RBI? That's the important question. And whether the NBFC regulation will be applicable to you. That's an important question because there are exemptions given under the existing framework of the NBFC. That IRDA is there. There are other regulators who will regulate these kind of NBFCs. Okay. So yeah, there are other regulations and exemptions given to these particular NBFCs where they will be regulated by other entities, not the RBI. So just to show you, in the NBFC regulation itself, okay. So for example, if I talk about, let's say, there is a exemption from the provisions of RBI Act. So there are exemption given under the provisions from the RBI Act. Okay, like certain NBFCs are exempted. For example, any NBFC which is into the microfinance loan. Okay, a Section 25 company not accepting deposit, securitization and reconstruction company, nidhi companies, mutual benefit companies, chit fund companies, merchant banking companies, then mortgage guarantee, housing finance institutions, insurance companies, stock exchanges, stock brokers, sub brokers, okay, alternate investment companies, then unregistered CIC. A lot of exemptions are given under the NBFC, existing NBFC regulations, and it is specified where they will be governed and how they will be governed. So Basically, there is a chapter 4 in the existing regulations which talks about the exemptions. They are not part of the NBFCs, even though they may qualify for the definition, but they are specifically said that okay, do not look over here, go somewhere else on to your regulator. So, okay, there is one more doubt. Can you give a small summary of the sequence, how it went? Okay, let me give you a summary. The summary, if I talk about again with respect to the section 45, how we started with the first section 45I for non-banking company. From there, we went to ICIE. Okay. And from there, we went to the business of non-banking financial institution, because the registration requirement comes if you are into the business of NBFI. Okay. So you can say that if you are into the business of NBFI, which is again, pointing towards the IC and IE or IF, okay, you are required to get registration. So you can start with 45 IA, that NBFC and NB business of NBFI. NBFC will take you to the F, and F will take you to the C and E, and business of NBFI will take you to the A part. A again, says you go back to the C and F, and you will come back to the C and F. So the main sections or main, hierarchy is start with the F, non-banking financial company, go to the C and go to the E, understand what is there, understand principal business, and then go to the registration requirements. Clear? Any doubt? No, it is just for the reference. You like do not like as of now, no need to go in the negative list. Okay. If no further doubts, what I proposed, like what we discussed, read both chapters, practice, and we will meet in the next session. Okay. Thank you. Thank you for participating. I'll see you in the next session. Thank you, guys. Session over. Yes, session over. Yes.
Recording stopped.